Alibaba is flying high right now. It's currently up about 9%. There was big news today. What was the big news? They're going to be splitting the company up into 6 different divisions that will all be able to operate independently and even go private, go public independently.
Yeah, 6 different CEOs.
6 different CEOs. I think they said there was one division that would not be allowed to, but why do they do this? Guys, a lot of companies will do this and it's part of their spinoffs. When they think the group is worth less than individual parts, they might sit there and say, listen, let's just treat these all as individual businesses. On their own, they're going to be worth way more than the group together. And Alibaba stock has struggled. And Mo and I were bummed to see this morning. I woke up and I was like, mother F, what the heck is going on?
When I saw it was the headline story, I was like, oh no. This is not good.
Because we were pushing for...
I was pushing for the 50s again.
All right, so let's pull up Alibaba.
And I do think it's going to come back down. This is an initial price reaction. It creates one of those gap patterns on a chart. Gaps fill, so.
Yeah. So Alibaba's all-time high of 320 back in October of 2020. All right, so a couple things here. Market cap, 224. Enterprise value, 245. So very little net debt. This is good. You know, guys, we want to focus on companies with good balance sheets because they tend to stick around longer. When recessions hit and problems occur, that's what's going to happen there. PE currently of 47 and a 5-year of 15. So this should be a red flag for you.
Yes.
What does this tell me? Well, they had a fluke year in terms of lack of profit. So I go to the income statement immediately. And I'm going to look at this going, okay, look at this profit over the last four quarters at a time. 2.54, 10, 5.5, 10, 10, 25, 23, 10, 4.8. So it's plummeted big time, okay? Now, is that a, oh wow, look at the net interest income. Wowzer. 9.25, wow. Woo. Special income charges. So guys, this is a company with growing revenue still. Revenue of $125 billion in the last 12 months and growing, and it has lost its luster on Wall Street. It's down 66%, 70% from its all-time high. Okay, let's take a look at the 8 pillars here. A lot of X's here. Mo, do you see these 8 pillars?
Yeah, they're pretty bad.
Yeah, awful. 5-year return on invested capital, 5.6. And Charlie Munger recently said it was his biggest investing mistake. And people are messaging me saying, Paul, what do you think of that? I said, that's what he thinks. He still owns shares.
Yeah, he gave the caveat of saying that he thought it was more of a tech company, and he just said it's a GD retail company.
And somebody said to me, like, no, Paul, his basis is 155. Well, his new basis is, but his original starting point was 250. Yep. He thought it was more of a tech company. Why does he like tech? High returns on invested capital. And when you have high returns on invested capital, you can really, really do a lot of damage and create that moat. I still own Alibaba. Don't buy it because I own it. Don't keep it because I own it. Do your own research. That's very, very important. I'm in this for the long haul on Alibaba. Yeah. When it was at $58 a share, I kept it. When it was at when it went up like to 120 or 130, whatever it hit in January, I kept it.
This is a perfect example of the media blowing things out of proportion about the Munger thing. Because I remember hearing that, and then I sat down and watched the 2.5 hours of him answering the question. And right when he answered the question, I was like, he didn't say this is his worst investment decision of all time just because there's fraud or something. Like, he made a very definitive statement about what it was, and I was like, oh.
Well, the other thing is, if you look at what people were saying when Alibaba started to fall, Paul, you don't really own the company. I'm like, well, yeah, I know. That's what owning a Chinese company is. You can't actually own the company. You own shares that have access to the cash flow from the other company, but you don't actually own shares of the company. And that was the reason. Now I don't hear that anymore. So again, guys, this is an example. And by all means, if you're not comfortable with it, you should not own any shares, ever. Don't ever own shares of a company you're not comfortable with. One of our best investors we know, Gary, I asked him, what do you think about Baba? He goes, all indications are it's a value play. I don't understand China though, so I avoid. Michael Burry recently bought Baba. When Baba was sub 100, he bought Baba. Smart guy. Yeah. Okay. David Tepper bought Baba. I believe it was David Tepper, was it? I don't remember. But the bottom line is Michael Burry, okay. Listen, the story at 60 is a lot different than the story at 160, different than the story at 260. So let's go take a look at analyst estimates. Now, this is in their currency, which we have not converted, but they're looking to increase their EPS by 50% over the next 5 years. Revenue is going to grow another 50% over the next 5 years. Okay, decent growth, nothing insane. the most important part here is the stock analyst. Oh my God, it's up almost 10% now,
I
Mo.
saw that.
All right, so I'm going to do a 20-year analysis on Baba. Baba has a lot of potential. Baba is in the world's fastest growing middle class market. Alibaba, if you ask me, has a lot of growth potential. And I like that, especially with them getting into their own cloud computing and things like that. Nothing to me has told me that I hate this company. Now, by the way, I'm down a lot in this business. My basis is around 150. Okay. I'm down significantly on that one. Okay. At one point we were down like 60%, 70%. You know what I mean? It's like, okay, that's fine. Didn't panic, just sat there and said, let's see how it goes. So I'm going to do a 20-year analysis. Mo's going to do a 10-year on our stock analyzer tool. And guys, this changes all the time. We're looking at wide ranges, and the range for Baba is very wide. Why? Because there's a lot of unknowns with China. How fast is it going to grow? Is the middle class, is it going to become more and more independent and democratic? Is it going to be less? These are the things that spread that very, very wide net of what the values could be. And that's our goal here, is to sit there and determine based on those values. And then, by the way, if you watch a different Baba video, we have a different value.
Yeah, you're going to see different numbers that I'm putting in right now.
But the overall goal is to look at it overall and say, yeah, but it's around this number. Just like Warren Buffett and Charlie Munger have said many, many times, we would not come up with the same value for Berkshire Hathaway. I did my 20-year analysis. Mo did 10. Mo, what'd you do for your revenue growth assumptions?
So I did 5, 9, and 13.
Nice. I did 4, 7, and 10 for 20-year analysis. Mo's was 10.
Yep.
Profit margin.
18, 21, and 24.
So I even went lower. I did 15, 19, and 23. But Mo, I don't think you're wrong.
Yeah.
I look at yours going, the last couple of years have been hit hard.
Exactly.
Yeah.
Exactly.
Free cash flow margin?
18, 21, and 24.
Same thing. 15, 19, 23.
Okay.
PE.
PE, I did 15, 17, and 19.
I did 15, 16 and a half, 18. Same with price of free cash flow.
Yep. 15, 17, 19. And my return, I did 10, 12, and 14.
Same with me. Now, guys, as you see, I went with really high numbers here, so I wanted a really high desired return to account for that.
Yep.
Mo, what'd you get?
Let's see.
I'm all green. How about you?
Same. 149 on the low end, 310 on the high end, and about 220 in the middle.
I was a low price of 120, high of 250, about 180 in the middle. All right, so I look at the saying, guys.
And this is the one I really focus on.
Yeah, and that's the funny part. We're below the lowest number. It's like, okay. I mean, that's my opinion. Again, do not buy because we have it, because there's going to be a lot of volatility in this company. You got to look at the chart. The volatility is insane. If you can't handle that, do not do it. But it's a good learning lesson to sit there and understand where we look at companies. If you like the software, $7 for 7 days, everythingmoney.com. Check it out.